everyone. So I think we can start. As I remember, this is the point I was starting. Non-amortization schedule. We have discussed it. We have discussed on that. Right. Okay. So after 2 weeks. So we are still on the time value of money. So you remember, we start with the different, when you are receiving the cash flows in the different time period. So you have to calculate present value or future equivalent value for the decision making. So likewise, we discussed how to determine present value, future value for the single cash flow, annuity, deferred cash flow, perpetual type cash flow. So likewise, we have discussed all these things. So now we are in the certain applications and the few questions, so then we can start the more evaluation. So as I remember, we discussed some questions related to the loan installment calculation also. We did this, no? This example. Yeah. So then you know how to determine the installment for a loan. So now we are going to prepare the loan amortization schedule. That is one application here. When it comes to the loan amortization schedule, it shows us how a loan paid off over the time. Loan amortization schedule shows us how a loan is paid off over time. So when you are borrowing some money from financial institutions or banks, so banks normally they calculate your installment. So now you know how to calculate installment because in the previous example we learned how to calculate the installment. So then what is you are doing? You may deposit the installment at the end of each year or at the end of each month. So then if you have borrowed for the 5 years, when you pay the installment for the 5 years, your loan is over. Loan is paid over. So now in this amortization schedule, it shows us how a loan is paid off over your loan period. So when it comes to this, so your installment include two components, right? You can calculate installment of the loan. So this loan installment include two components. One is interest component for the period, interest amount, and the other one is loan repayment. From your borrowed money, from your capital, how much you are repaying for this particular period. So this installment includes these two components, and also you might have heard that normally interest is calculated based on the reducing balance. because bank is not always calculating the loan interest for the your total amount borrowed, but when it's paid off over time, so your interest component is decreasing because the loan interest is calculated based on the reducing balance. So that is also happening with this amortization schedule. You can see when it's come to the installment consists with the two components. So you can break down it into two, interest component and principal repayment. Right. So now I think this is not much a difficult one. So with the example, we can prepare loan amortization schedule. So then you can understand this one better. Now look at this example. Mal has obtained a bank loan valued 400,000 to be repaid in 4 equal annual installments beginning 1 year from today. So you calculate what is the month's annual payment or what is the annual installment of this loan. So then we are going to construct amortization schedule for this loan. So first calculate the installment of this loan, because now you have learned to calculate the installment. So calculate the loan installment. In a previous example also we did the similar type of action, so therefore you can determine the installment. There is a 400,000, non-borrowing is 400,000. Interest, annual interest rate is 16%. Interest rate is 16%. Loan period, 4 years. 4 years. So now you calculate what is the annual installment of this loan. So you remember when you calculate the annual or the monthly installment of a loan, so you are applying present value interest factor annuity formula, or you should know what is the present value interest factor annuity for this particular rate and for this particular period. So then you are applying here present value interest factor annuity formula. Because now if you draw the timeline for this loan, so you are borrowing today 400,000 to be repaid in 4 years. 1, 2, 3, 4. In 4 years. So you are paying your annual installment for 4 years. Right? Once you paid this 4 years annual installment, your 400,000 loan will be repaid. Right? So therefore, present value of this installment is equal to the amount or the loan amount. Present value of this installment is equal to the loan amount. So therefore, we are applying here present value interest factor annuity formula. So you can remember present value interest factor annuity formula. You have to apply present value of annuity. Present value of annuity is equal periodic payment or cash flow into what is the formula? 1 minus 1 plus r into the power minus n divided by r. So you can apply this application here to determine the installment. So present value of annuity is equal 400,000. Cash flow or the periodic payment we are going to calculate here. Periodic payment we are going to calculate here. So that is your annual installment. So here you have to work out present value interest factor annuity. 1 minus, this is annual installment. So no need to do any adjustment. 1.16 into the power minus 4 divided by 16%. So likewise you can calculate annual installment for this loan. How much is it? Interest rate is 16%, like 4 years. Percent value interest structure annuity you can calculate. Is it 2.79? Right. So the loan value or the amount you borrow is 400,000. So then you can identify installment of this loan. $142,950. Right. So this is the installment 142,950. I think it is correct. So now we are going to prepare amortization schedule. So this is the 4-year loan. So your amortization schedule will be looks like this because this is a 4-year loan. So therefore you need only 4 columns. If it is a 30 years, so you have to go with the 30 columns. So like this. So normally basic information like beginning balance or the opening balance, your installment, interest for the period, capital repayment, ending balance will be included in the amortization schedule. So now we are going to prepare this amortization schedule for this loan. So you may prepare a table like this. So now we are going to prepare this amortization schedule. So this is 4-year loan. So your amortization schedule like this. Right. So now if you are going to prepare this one, now opening balance of this loan, it is the amount you borrowed is 400,000. It is 400,000. So your installment now we have already calculated it, 142,950. So that is not changing over the time. This is annuity. So you can, what is you are doing actually, you may pay this installment for this 4 years to the bank. So then your loan will be over. So this is annuity, this is fixed, not changing installment. So therefore you can see in the end of year 1, year 2, year 3, year 4, you are paying 142,950. That is the annuity. So interest rate for this loan is 16%. Interest rate is 16%. So then you can calculate interest component for the year 1. So for the year 1, bank calculate interest on 400,000. So therefore interest for the year 1 is equal 400,000 into 16%, 64,000. Year 1 interest is 64,000. In your installment, it is two component is there. Your installment is 142,950. This is annuity. So in this installment, two components are there: interest for the period and the loan repayment. For interest for the year 1 is 64,000. Interest amount for the year 1 64,000. So then how much the loan repayment? From this 142,950, you have to deduct this interest component. So then your loan repayment is 78,950. So this is the first year 1 loan repayment. So likewise, you can then calculate a loan repayment is equal 142,000 minus 64,000. So then your ending balance at the end of year 1 is equal 400,000 minus repayment of the period 321,050. So that is the outstanding balance of your loan at the end of year 1. So then this is the beginning balance of your loan year 2, 321,050. 321,050. So now bank calculating interest based on this value, not the 400,000, because now your loan balance at the beginning of year 1 is 321,050, because you have repaid 78,950 in the year 1. So therefore, year 2 opening balance is 321,050. So now interest is calculated based on this value. So then how much the interest? 321,000 into 16%. 51,368. So then you can calculate loan repayment year 2, installment minus interest 91,582. Balance or the outstanding balance of your loan at the end of year 2 is equal 229,467. So then this is the opening balance for the year 3. So now interest calculate on this balance 36,740. So your loan repayment year 3 is 106,235. Then ending balance end of year 3 is equal 123,232. So this is the opening balance for the year 4. So now bank charge interest on this 16%. So this is the interest component. So now if you get the total here, you can see loan repayment is equal 142,000 minus interest. This is equal to outstanding balance. So now equal to 0. Loan balance equal to 0. Now if you look at this amortization schedule, what you can see over the time, what is the behavior of the interest component? Over the time, interest for the period increases. Why? Interest is calculated on reducing balance. At the year 1, interest calculated on the 400,000. Year 2, 321,050. Then 229. So likewise, interest has calculated based on the reducing balance. Right. So you can see interest component is decreasing over the time. So what is happening to the loan repayment? Over the time, over the loan period, loan repayment increasing. At the very beginning of the loan, bank is not deducting large amount. But when the loan is matured or when it is paying the loan or the period, so you can see they are deducting the amount or the size of the loan repayment is increasing. So you can see then the interest is decreasing, loan repayment is increasing, so then loan balance is decreasing. So therefore interest component is decreasing. So this is the amortization schedule. Now, do you remember this question? In the previously we discussed kind of example like this. This one. In this section, I asked you to calculate what is the loan balance outstanding at the end of 4 years. Right? So now with the formula, by applying formula, here you calculated loan outstanding balance. So likewise, 4.8 million something. Now, by looking at the amortization schedule, quickly you can have idea about the loan outstanding balance. Now, if you go to this prepared loan amortization schedule here, so loan outstanding balance at the end of year 1, 321,049. Loan outstanding balance at the end of year 3, 123,233. If you are going to settle down the loan, so then at the end of year 3, you have to pay this. If you are going to settle the loan. If you are going to settle the loan at the end of year 2, so you have to pay 229,467. So same you can calculate by using the formula also. Now if I apply the formula to calculate the loan outstanding balance at the end of year 3. Now this is our timeline here. 4 years loan, 1, 2, 3, 4. So I want to identify loan outstanding balance at the end of year 3. Right? So I have to pay one more installment because this is a 4-year loan. We have to pay more, only 1 year loan, installment. So then your loan outstanding balance here is equal present value at the end of year 3 is equal your installment here 142,950. Annual installment 142,950. So loan outstanding balance look here is equal This 142,950 you have to discount it. Okay? So then if you discount this one by, see whether you are getting this answer. You have only one installment here. This is not an annuity. This is a single cash flow. So therefore, simply by discounting this 142,950 back for 1 year, so you will get the answer. That means 142,950 discounted by 1.116 into the power 1. What is the answer? Okay? You are getting the same answer. If you want to calculate the outstanding balance here at the end of year 2, so then you can apply annuity formula, present value of annuity formula. So present value of annuity formula, you know what is that? 142,950 into 1 minus 1 plus R, so that is 1.160. So I want to calculate outstanding balance here, end of year 2. 2 more years are there for the loan. So then end of year 2, loan outstanding balance is equal 1 minus 1 plus R into the power minus 2 divided by R. So solve this and see whether you are getting 229,467 by solving this. You are getting that one. So outstanding balance you can take by looking at the amortization schedule, or you can apply formula like this to calculate the outstanding balance. Right. Okay. I think it is not difficult. You can prepare loan amortization schedule for the exam without any difficulty. This is easy. Okay. Right. So now this is actually end of the time value of money. So few questions are there very quickly without taking much time. Very quickly. If you can do by yourself, I can skip and I can start the conversation. Just look at this thing very quickly. Yeah? Don't take much time. Now the time value of money is over. Look at this one. A used car sells for 7.5 million. The buyer of this car wishes to pay for it in 48 monthly installments. The first is due on the day of purchase. These are from your tutorials, right? I have taken some questions from your tutorial, so other questions you have to do yourself. But I have taken some difficult type questions. If 24 interest compounded monthly, find the size of the monthly payment. I think you can do it now. These are the applications. These are the applications. So this is the question. So you sell the used car for 7.5 million. The buyer of this car wishes to pay for it in 48 monthly installments. So if you draw the timeline here, so today you are selling your car at say 0. Buyer wish to pay this 7.5 million. 48 monthly installment. This is go up to say 48. Right, 48 monthly installments. First is due on the day of purchase. What it said? The first installment is due on the day of purchase. So it implies what? Huh? Ordinary or due? Due. First installment you have to pay on the day of purchase. It means that the first installment is happening at the beginning of your period. So therefore this is a due annuity. This is the due annuity. So you have to apply the appropriate formula. So you 24% compounding monthly. So then you calculate it. How much the installment? So you remember when there is a due annuity, our formula you have to just fit. So this is the formula. If there is a due. So apply this and calculate the monthly installment. Annual interest rate is 24%. So then monthly it is 24% divided by 2. So then 12, that is 2%. In here 48 monthly installment, 48. So present value interest factor annuity due how much here? 1 minus 1 plus R 2% to the power minus 48 divided by R. So this is ordinary annuity factor. So this ordinary annuity factor you have to multiply by 1 plus R. So that means 1 plus 2%. So I am applying the formula, right? You can do by using your calculators. Is it 31.28 factor? Then your monthly installment the amount is 7.5 million. So here the monthly payment, the present value of the monthly payment is equal to 7.5 million. So we are applying this formula. So you calculate this annuity factor for the due annuity. So then we have to identify installment or the periodic payment. So simply periodic payment is equal amount borrowed or the amount that you have to pay divided by factor. Annuity factor, due annuity factor. Is it this one? 239,790. Correct. Here. But I think that's all. This is due. The normal ordinary annual factor you have to multiply by 1 plus r. 1 minus 1 plus r into the power minus 48 divided by F11 is the r. Multiply 1 plus r. Formula එක නම් හරි. Is there any mistake? Did you get this answer? So your monthly payment is 239,709 in order to settle this liability. So you have to pay 239,709 per month. Right? Okay. So let's go to the next one. Jayawardhana wishes to collect 1 million to purchase the land. In order to collect that money, he wishes to deposit 3,633.50 cents each at the end of each month in a bank account that pays 15% per annum compounded monthly. So that after taking the last deposit, he would have desired some money in the account. Determine the number of deposits he will have to make. Application. So that person wants to collect 1 million. To collect this 1 million, he is making some deposit in the bank, which pay 15% interest per annum, compounding monthly. So the monthly deposit is 3,633.50 cents. So how long will it take to get the 1 million? If you assume that 15% interest is constant throughout this period. What is the application here? This 1 million is equal to what? 1 million is equal to future value. In some future time, you want to have 1 million. This deposit 3,633 at the end of each month for in account which pay 15% annually, but compounding month. So then 1 million is equal future value of your deposit. So what is the application? What is the applicable formula for to solve this? Future value of annuity formula. Future value of annuity formula you have to apply. So future value of the annuity, future value of your monthly installments, monthly deposit is equal 1 million. Your monthly deposit or the cash flow or the periodic payment is equal 3,633.50 cents. Right? 3,633.50 cents. So you are depositing this money in an account which pays annual interest 15%, but compounding monthly. So this is the annual interest. So then you have to identify monthly interest rate because the you are making deposit monthly. So therefore your compounding frequency also should equal to the monthly. I think you remember in the assumption in the timeline, cash flow frequency should equal to the compounding frequency. The cash flow frequency here monthly. Cash flow frequency monthly. So therefore you have to compound this cash flow also monthly. So then you can apply future value of annuity formula. Future value of annuity is equal cash flow into what is that? 1 plus r into the power n minus 1 divided by r. So apply the formula and calculate. Future value of annuity is equal 1 million. Periodic payment is equal 3633.50. අපි දන්නේ මොකද්ද? time එක. කොච්චර කාලයක් how many months you have to deposit this in order to accumulate 1 million. How many months you may have to make this deposit. So you have to identify here n. So how much the 15% divided by 12? 0.0125, the 1 plus 0.125 into the power n minus 1 divided by 0.125. Solve this for n. This is your fraction, right? So to solve this, first you can divide 1 million by 3633.50. So then you will get 275, right? 275.172721 is equal 1.0125 into the power n minus 1 divided by 0.0125. So then you can have a cross multiplication again. So 275,001 multiplied by 0.0125. Then 3.44021. Right? 3.44021 is equal 1.0125 into the power n minus 1. So this minus 1 you can take to here. So then minus will be positive. So then positive 1 means, so this will become 4.44021. So now here, from here what you have to apply to get the n? Log. So you can, that is the easy way. So you can convert this into log. So accordingly, so now there is no minus 1. So log 4.44021 divided by log 1.0125 is equal to n. How much then? 100 months you have to make this 3,633 in order to accumulate 1 million. 1 million products which are Galle the society in the Galle deposit karambaya. 190. Yes, correct. 119 or approximately 120 months you have to make this deposit to get this 1 million. Right. Right, look at this one. To complete your last year in business school and then go through the law school, you will need 100,000 per year for 4 years, starting next year. That is, you will need to withdraw the first 100,000 1 year from today. Your rich uncle first to put you through school and he will deposit in a bank paying 7% interest, a sum of money that's sufficient to provide the 4 payments of 100,000 each, 7% interest per annum, right? This deposit will be made today. How large must be the deposit? You have a requirement of 100,000 for next 4 years to pay for your college school or the law school. So your uncle is deposit some money today, so that is sufficient you to make these required payments. So you are asking what is that deposit amount? How much that uncle should deposit today to make these withdrawals or to make these payments? Right? That is the part A. How much will be in account immediately after you make the first withdrawal? After you are taking the first 100,000, how much your account balance? After the last withdrawal, how much the account balance? Try to do this, not difficult. So, what is the application here? What is the formula? How much you may deposit? How much that uncle should deposit at the beginning of the period? So this you can apply present value of annuity formula because starting from the next year, you want to have 100,000 withdrawal at the end of each year. So if you draw the fine line here for this section, it is like this, right? So this is 0, 1, 2, 3, 4. So you will need 100,000 per year for 4 years starting next year. So then first withdrawal will be there. 100,000, 100,000, 100,000 and year 4. 4 withdrawals you want to have to make some payment. So your uncle today is deposit some money in order to achieve this objective in an account which pays 7% interest annually. And so how much the deposit here? So then you can apply, so the amount or the value of the deposit should be equal to present value of these cash flows, present value of these annuities. So you should deposit present value of these annual withdrawals. So then you can apply present value of interest fact annuity table, and you can you will get the answer 330 8,721 is the monthly, sorry, annual. No, this is the amount that he should deposit at the 0. 338,721. So after that there is no any deposit. After that there is no any deposit. Only withdrawing from the account. You are withdrawing 500,000 at the end of each year. So after the first withdrawal, how much the account balance? So now today his deposit 338,721. So then from here to here, you are getting interest at 7%. When the 338 721 approach to the end of year 1, you are getting 7% interest for that period. So then your account balance at the end of year 1 will be 362,431. So then you are making your first withdrawal 100,000. So after the first withdrawal, then your account balance is 262,431. Then you are getting interest for this 7% interest from bank. So then 262,431 into 7%, your interest is 18,370. So balance at the end of year 2, 280,801. So then you are making your second withdrawal, 100,000. So then after the 100,000 withdrawal, at the beginning of year 3, your account balance is 118,801. So you will get the interest 126,656. So then you are making withdrawal. So at the beginning of year 4, you can see your account balance is 93,457. So you are getting 7% interest. So at the end of year 4, you can withdraw 100,000. After withdrawing this, your account goes to 0. Your account goes to 0. I feel the clarification and equation. Okay. So for the exam, you have to ready for a question like this, right? So we are not asking to calculate present value, future value, or like equation. So you have applications like this. So you have to apply the things you learn to solve a question like this. Right. Okay, right. Let's go to the next one also, because I think I will explain at least the way of doing. So then you can go and do at home. Look at this. Kumara is celebrating his 14th birthday. Kumara is celebrating his 40th birthday, and he is considering an investment plan where he is required to make monthly deposit 7,000 starting 1 month from today and continue payment until he becomes 55 years old. After making the last deposit, no transaction will be made over the next 5-year period. But interest will be accumulated. Starting from the 60th birthday, he plans to make 60 equal monthly withdrawals from the fund at the beginning of each month. The fund earns interest rate 12% per annum compounded monthly. So you ask to calculate how much money will be accumulated in this fund on Kumara's 60th birthday. What is Kumara's monthly withdrawal? Right. So what is this fraction? Kumar is celebrating 40th birthday and he is considering the investment where he deposit 7,000 starting 1 month from today. So today he is celebrating 60th birthday, 40th birthday. He is planning to make deposit investment plan 7,000 starting 1 month from today. Starting 1 month from today, he is going to deposit 7,000. 7,000. Continue payment until he becomes 55 years. So now this is his 40th birthday. Then he is continuing this up to 55 years old. So then how many months? 40, 55. How many years? 15 years. This is monthly deposit now. 15 into 12. So then how many monthly deposits? 180. So he is making up to 180 month 7,000. At the end of each month, 7,000 in the account which pays interest 12% compounding monthly. After that, after making the last deposit, after making this last deposit, no transaction will be made over the next 5-year period. So then next 5-year period, there's no any transaction in the account. So next 5-year mean this is 5 years. So 5 years mean in 60 months. So then here 60 months. So that means 55, 60 years old. For these 5 years, in the account, there is no any transaction. No any transaction during this 5-year period for the 60 months duration. Up to until, but the interest will be accumulated. Right? We have deposit 7,000 up to this month, but interest is accumulated. Interest is calculated in the account. Starting from the 60th birthday, he plans to make 60 equal monthly withdrawals. He is planning to withdraw 60 monthly withdrawals. From the 60th birthday to the future, he is planning to withdraw 60 equal monthly withdrawals for the 5 years again. 60 kilo 5 years. So you ask how much money will be accumulated in this fund on Kumara's 60th birthday? What is the Kumara's monthly withdrawal? Monthly withdrawal the very important point monthly withdrawals beginning of each month. Here monthly withdrawals are happening beginning from each month. Again, withdrawal 60th period. So beginning from each month. Is it complicated one? So you can see now you are in the 40th birthday. So you are making 180 monthly deposit up to you reach to the 55-year-old. Then next 5 years no any transaction. අවුරුදු 5ක් නිකුත් account එකේ transaction නැහැ interest එක calculate වෙනවා. ඊට පස්සේ 60th birthday එකේ ඉඳන් ඔයා 60 installments withdraw කරනවා. That is the equation. ඉතින් ඔයාගෙන් අහනවා මෙතනට accumulated fund එක කීයද? If you deposit like this 7,480 months, how much will be accumulated when you reach to the 60th birthday? Method accumulated fund. Method what is the monthly withdrawal? What අවුරුදු 5ක් withdraw කරන්න ඕන. So how much your monthly withdrawal? Try to do this. From where you start this one. So first you can calculate. In the question it says your monthly deposit is 7,000. So therefore you are making 7,000 at the end of each month for 180 months in the account which pays 12% interest per annum. So then you can calculate value here. This is the future value of annuity. You deposit some money, 7,000 for 180 months. So then you can apply future value of annuity formula and you can calculate accumulated value. You can calculate accumulated value for here, for this period. මෙතනට කීයක් accumulate වෙලා තියෙනවද කියලා හොයාගන්න පුළුවන් by applying future value of annuity formula. So accordingly, what is the answer? So future value of annuity, future value annuity factor is how much? Future value interest factor annuity equal 1 plus R. R is annually 12%. So in monthly it is 1%. So 1.01 into the power 180. 1 plus R into the power n. This is the formula. No, what is the future value annuity formula? This one. One plus R to the power n minus 1 divided by R. This is, you can apply this 1 plus R into the power n minus 1 divided by R. So then future value annuity factor is equal 1 plus R means 1.01 into the power 180 minus 1 divided by R. R again 0.01. Here the present future value interest factor annuity again. R is 12% per annum. Annually 12%. Yes, 12% per annum. So 1% monthly value. Here minus the the accumulated value here is equal 499,058 into 7,000. Monthly 7,000. So then that is 3.4 million. 3.4 million 97,061 will be accumulated for here when you reach to the 55 years. The method there is no any transaction next 5 years. So then, but interest is calculated. So there is no any cash deposit or withdrawal, but you are getting interest for this account. So then what is that? Normally you can apply future value interest factor. You can calculate the value to the end of 60th or the end of this 5 years. So simply what you have to do, you can multiply this 3.4 million 97,061 into 1.01 into the power 1.01 into the power 60. 1 plus R future value, normal future value, there is no annuity. So simply you can take 1 plus R into the power n. So then you can because the interest is calculated for this period. So this is the balance at the end of 180 months. For these 5 years, interest is paid, right? The annual interest is 12%, but the compounding frequency here also should be monthly. මොකද මේක වෙනස් වෙන්න බෑ මෙතනට annual ගත්තොත් fundamentally that is wrong. මේක දෙකක් වෙන්න බෑ මේක එකම investment එකනේ so therefore for this 5 years also interest is calculated on monthly so therefore this 3.4 million 97,061 into 1 plus r that means 1.01 into the power 60 into the power 60 so then you will have this much 6.3 million when you reach to the 60th birthday you will have 6.3 million 53,099 so මෙතනින් එහාට you are making 60 withdrawals from here to onwards you are making 60 withdrawals beginning from the period right from here to for another 5 years according to this question for another 5 years you are making now withdrawals 60 withdrawal හැබැයි මේ question එකේ කියනවා withdrawals you are making you can see but the 60 monthly withdrawals from the fund at the beginning of each month at the beginning of each month so therefore now what you have to apply so calculate the monthly withdrawals so this 6.3 million 53,099 is equal value or the present value of your monthly withdrawals. So here you have to apply present value annuity factor table and you have to identify the monthly withdrawals. The method of accumulated value එක ආවා 3.4 million 9761 it was a period eකට මේකට interest එක හම් වෙනවා for the 5 years so therefore at the end of 60th birthday you will have 6.3 million ඔයාලට මෙතන වෙනකොට හම් වෙනවා 6.3 million 53,099 දැන් මෙතනින් එහාට ඔයා withdrawals you are making 5 years withdrawal එතකොට ඔයාගේ monthly withdrawal එක කීයද how much your monthly withdrawal for 5 years you have to make withdrawal 60 withdrawal එතන ඔයාගේ monthly withdrawal එක ඔයාලට calculate කරන්න පුළුවන් ඔයාගේ monthly 60 withdrawals වල මෙතනට value එක සමානයි 6.3 million so then you can apply present value of annuity formula is equal 1 minus 1 plus r into the power minus 10 divided by r 1 plus r because this is withdrawals at the beginning of the period මෙතන withdrawals වෙන්නේ පළවෙනි withdrawal එක මෙතන පටන් ගන්න තැන මෙතන ඉඳන් යනවා 60 එක 60ක් කරනවා ඒතර පළවෙනි එක at the beginning of the period so therefore this is a due type annuity withdrawals are happening at the beginning of the period so therefore you have to multiply this normal annuity factor by 1 plus r so then how much your monthly withdrawal it should be equal to 63,53,099 into monthly withdrawal එක තමයි අපි හොයාගන්න යන්නේ 1 minus 1.01 into the power minus 60 divided by r 1% multiplied by 1.01 so how much your monthly withdrawal Is it 139,921? you need any explanations or the clarification, ask, right? That was the this question for the next first 15 years, your deposit by 7,000. The අවුරුදු 15 අවසානයේ ඔයාලට හම්බ වෙනවා මෙච්චර 3.4 million. ඊට පස්සේ අවුරුදු 5ක් ඒකට නිකම් ඉන්ට්‍රස්ට් එක හැදෙනවා for the 5 years. එතනින් එහාට from your 60th birthday at the beginning of that period, you are making 5 years withdrawal. 5 years withdrawal. So our monthly withdrawal is 139,920. I think this one you can manage by yourself. This is related to the amortization schedule. I am not going to do this one. So if you read quickly this one, Susila obtained a loan 1.7 million from Sampath Bank and is to be repaid in equal monthly installment where interest is compounded monthly. An extract of the loan schedule provided by the bank is follows. So already dila thiyena loan amortization schedule එකේ කොටස for the first 5 months. Susila has maintained good relationship with the bank and the installments are settled on time. However, she has not been able to settle the last 5 installments. When settling these outstanding installments, a penalty of 2% will be charged by the bank on the total outstanding balance. If Susila intends to settle the loan fully, when she makes the final payment together with the delayed installment, what is the payment to be made in the final installment, final month? So again, application of the amortization schedule. So there is a loan to be repaid in monthly installment. Already make a කොච්චර කාලයක්ද කියන එක දීලා නැහැ, but part of the amortization schedule is provided. ඉතින් මේකේ කියනවා මෙයාට she has failed to pay last 5 installment. There is a default or however she has not been able to settle the last 5 installment. එතකොට ඒ 5 installments ගෙවපු නැති එකට බැංකුව charge කරනවා කියලා තියෙනවා penalty එක. Year loan installment. By looking at the amortization schedule, you can identify loan installment, interest plus capital repayment. Your loan installment is 24,309. කොච්චරක් ගෙවන්නවද 5 installments arrears වෙලා තියෙනවා. එතකොට ඒකේ future value එක කරා ඒකට 2% penalty එකක් charge කරනවා. මේක advance එක. So you can check it. You can do it by yourself, right? So future value installment 5 future value එක ගත්තා ඒකට 2% penalty එකක් add කරා. Right. This one also you can manage. Loan outstanding value. Gayatri obtained 25-year loan 15 million 11 years ago. She is required to pay monthly installment 157,983. Interest is 12% per annum, compounding monthly. At present, the market interest rate has come down. Right? She has obtained 25-year loan 11 years ago. අවුරුදු 5ක loan එකක් අවුරුදු 11කට ඉස්සෙල්ලා අරන් තියෙනවා. Right? Monthly installment, right? Installments are on the monthly basis. Interest is 12% per annum, compounding monthly. At present, market interest rate come down, so Gayatri is planning to take advantage of reduced interest rates by settling the existing loan with a new loan. දැන් මම මේකද කරන්නේ මේ existing loan එක settle කරලා අලුත් loan එකක් අරගෙන අලුත් loan එකක් කරලා existing loan එක settle කරන්න යන්න. She want to settle the existing loan with a new loan at the new rate. How much should she borrow at the new market interest rate to settle the loan? $25 years loan she has obtained 11 years ago. और this is का loan लेगा 25 years loan she has obtained it 11 years ago. और देखो यहाँ का डिस्कशन लगा दिए ना ना इस तरह किया गिवन कितना में loan है 14. ठीक है 11 years ago तो हमारा कितना इस तरह का कितना गिवन किया और 10 तब इस तरह का किया 14 years monthly installments 14 into 12 installments. How much? 160. 180 installments are there to be 16. 168. So now the market interest rate has decreased. So now she's trying to get the advantage of that. She is going to settle this existing loan by taking another loan at the new interest rate. इधर वाला कहाँ के new interest rate का ना loan के amount कितनी है? කොච්චරද යාලා ये අලුත් interest rate එකට borrow කරන්නේ? මේ තව විදිහකින් අහන්නේ මොකද්ද මේ? 25 years loan has obtained 11 years ago. इधर तब मेजर 168 monthly installments are there to be paid. इधर मेजर loan outstanding balance එක මෙයා ඒ balance එක එයා borrow කරන්න ඕන අලුත් loan එකක් විදියට. इधर මේක settle කරන්න. ඒක තමයි මෙයා අහන්නේ. In a different way rather than asking the loan outstanding balance, so you are asking the different way. How much should borrow at the new loan? Make outstanding balance එක borrow කරන්න ඕන අලුත් interest rate. So you have to calculate outstanding balance. අපි calculate කරා ඉස්සෙල්ලා. So you have to borrow 12,829,286. Right. So this is end of the time value of money. So you will have a 20 minutes break, 15 minutes. Come back to start the conversation. එක question එකක් අහන්නවා මට ඒක මේ අරකේ අර සෙවෙන් අර මේ ස්කෝලරින් වලට මිනිමම් 12ක් විතර දැනනවා මට සාමාන්‍ය නැහැ එතනට ගන්න නැතුව මම ෆික්සස් ටිකක් මෙතනට දාගත්තා මොකද හදන්න ලේසි හින්දා. ඉතින් මේක ඒක ගන්න මේ අවසාන දේව ගත්තා. මෙන්න මේක තමයි එක. මේක එක ලෝන් එක. මේ අන්තිම ගණන් ටික මම නැතුව මොකද ඒ වන චුට්ටක් අමාරු. ටියුට් එක. මේ ඔක්කොම හදන්න ඕන. මේ ඔක්කොම හදන්න තමයි දාලා තියෙන්නේ. මම අර සිලෙක්ට් කරලා ගත්තා අමාරු ටිකද මේව ඔයාලට පුළුවන් මේ ෆීල්ඩ් එක හදලා. මේ ඇප්ලිකේෂන්ස් ටික තමයි මම හදුවේ. මේ හදලා වරන මොන හරි අමාරු දෙයක් තියෙනවා මම අහන්න. PowerPoint එක. හරි. So we can start now new topic, bond valuation. So valuation or the value, the concept of value now you have learned. So therefore we can apply the concept, the time value, the things you learn under the time value for the asset valuation. So under this we discuss bond valuation, security, common stock valuation, preference share valuation. Right? The concept or the things you learn we are going to apply now. Here we discuss financial asset valuation, but this concept value you can apply not only the financial assets, even to the real assets. For to take the decision, see whether this is undervalued or overvalued. So likewise to make a decision, you can apply this concept. Right. So I think therefore this is easy because the fundamentals now you have learned. So therefore discounting and the things you have learned, so we can apply it easily. If you look at the learning outcomes, at the end of this session you will learn, because this is bond valuation, you will learn what is bond, different types of bonds, the common stock valuation and the preference share valuation we discuss in the next lesson. Under the bonds also you will see interest rate risk, YTM calculation, yield identification, so likewise certain things you will learn. Right. Before going to the bond valuation, so you should know what is this intrinsic value. Nothing, actually nothing anything. Intrinsic value means simply present value of future expected cash flows of an asset. So that is we call intrinsic value, future value of the future, the present value of the future cash flow. So that is for financial assets, you can calculate intrinsic value. For a real asset like a machine, equipment, even you can calculate intrinsic value. So now you know how to calculate the present value by discounting some discount factor. In the time value of money, we define it as a discount factor. Now in this bond valuation, security valuation, we define this discount factor as the investor's required rate of return. In the risk and return, so we are going to calculate required rate of return based on the portfolio, so like that. So intrinsic value of fundamental value is equal present value of the future cash flow of any asset. So when you calculate the intrinsic value, we consider cash flows, not the profit. Right? It's based on the cash flow and timing and the size of the cash flow is affected to the value, because you can see the fundamental model of the value calculation is equal expected cash flow in some future be discounted by some discount factor. So this is the fundamental model. In time value of money, we define this as a discount factor. So this discount factor in the security valuation, in the bond valuation, we define as investors' required rate of return. Bond holders or the bond investors require rate of return. Ordinary share, common shareholders require rate of return. Debt capital providers require rate. So likewise, we define the same discount factor here as the required rate of return. So value, intrinsic value depends on cash flow, not the profit. You know the difference between the cash flow and the profit. When we say the profit includes non-cash item. Cash flow means that is pure cash flow. Return is a cash flow. This value is affected by the size of the cash flow. When the amount or the size of the cash flow is very large amount, value is increased. And also it's affected by the time, end. You can remember time value of money theory. Money receiving today more valuable than money receiving tomorrow. So when the end is increasing, when you have to wait long time to get some money, value is decreasing. So that is affected with the timing as well as the size of the cash flow. So when you calculate in the value, now you know this discount factor reflects investors' required rate of return. So normally investors' required rate of return, is equal, in my next risk and return, I am explaining this one again actually, equal risk-free rate of return plus risk premium. Right? Investors' required rate of return is equal risk-free rate of return plus risk premium. So this risk-free rate of return for the time value of money. If it is risk-free, if there is no any risk, if it is a risk-free rate of return, so this return for what? For the time value. The proxy for the risk-free rate of return is normally we take treasury bill rate of return, treasury bond yield as the risk-free rate of return, because theoretically we identify it as a risk-free rate of return because they are issuing by the government, there is no any default risk, so therefore we identify them as a risk-free investment. But reinvestment risk, market risk, interest rate risk, these are there. Only the default risk or the credit risk is free. So this risk-free rate of return is reflect value of the money, time value of money. Then risk premium for bearing the risk. Because now suppose that if you invested bonds of a company, you are a debt provider or the bond holder of that particular company. If you invested in ordinary shares of a company, you will be a owner of that company. Okay? By investing in the ordinary shares, you can be a owner. But if you invested in the bonds, you will be a debt capital provider. So normally, if you consider the risk aspect, bond holders and the equity shareholders, who is taking high risk? Now, I think you know what is bonds, right? I will explain it, but anyway, you know what is bonds, no debentures, bonds. If you take the bond holder and the ordinary shareholder are the owners of the company, if you compare these two in aspect of the risk, who is taking high risk? Shareholders or the ordinary shareholders or the owners, because you know that for the bonds there is a fixed interest, fixed coupon, but for the ordinary shareholders there is no fixed dividend. It depends on the profit, economic situation, investment. So like the certain factors are affecting, there is no fixed dividend. And also I will explain later also, if there is a bankruptcy, bondholders have right to claim their investment at first before the ordinary shareholders. Ordinary shareholders have to wait until the last, until paying all the obligations to get something if they have in the company for them. So therefore, there is risk. Right. So then on that aspect, ordinary shareholders are taking high risk. So then bondholders require rate of return and the ordinary shareholders require rate of return. Are they same? No. Their required rate of return or the rate they require for this investment are not same. Different assets are having different rate of return because of what? Because of this. Because of this. If you are taking high risk, if you are investing in the high risk investment, your required rate of return should be for that risk level. If you are investing in the treasury bills, this is your rate of return. That is risk free. So therefore its rate of return as compared to the investment in the risky investment, it is low. So therefore different assets are having different rate of return because of the risk. In the risk and return we will discuss that one again. But here the bond valuation. So this discount factor here reflects required rate of return. Right. So this is the fundamental or the basic model of the value determination or the value calculation. So this model you can apply for any asset, not only the bonds, debentures like financial assets, even for a real estate or the fixed asset, even you can apply. So the expansion of this model you can see if the asset lifetime is 10 years, you have to identify expected cash flows for this particular asset for the 10 years. So you have to discount it then back to the present. So that total we call as the intrinsic value. Present value of time value present value of what? Annuity value. So you can apply to calculate any intrinsic value for any asset. If you look at the denotation for the variable, V is the intrinsic value or the fundamental value, theoretical value. So we are using different terms for the here value, intrinsic, fundamental, theoretical values are likewise. CF, cash flows expected in the time period T. T is the time period. N is the lifetime of the machine, it is 10 years, so that is 8 years. R is appropriate discount rate, or this appropriate discount rate is what investors require rate of return. Right? So now, if I ask you here, if I ask question like this, what is your required rate of return at present? How to trace that? By looking at what? Yes? Yeah, if you want to identify that මේවට ගණන් වලට ඔයාලට required rate of return එක දෙනවා. දැන් අපි හිතමුකෝ personal decision making එකට ගණන් හදන්න ඕනට, so then you have to identify reasonable appropriate discount rate. That is your cost of fund, that is your required rate of return. Then අපි කොහොමද ඒක identify කරගන්නේ? By looking at දැන් අපි හිතමුකෝ ඔයා මොකක් හරි you are going to invest in the stock market. එතකොට ඔයාට රිමයින්ඩ් කරගන්න ඕන සාධාරණ වශයෙන් ඔයාගේ ඩිස්කවුන්ට් ෆැක්ටර් එක කීයද? ඔයාගේ cost of fund කීයද? ඔයාගේ required rate of return එක කීයද? කොහොමද අපි ඒක හොයාගන්නේ? දල වශයෙන් approximately. Yes, මොකද කිව්වේ? හා? මොකද? සර්? Central bank, yes, you can look at the prevailing market interest rate. So this prevailing market interest rate, if you invest this money in a fixed deposit, you will have 10%, 11% like. Instead of this fixed deposit investment, if you are going to invest in the stock market, if you expect 12%, 11%, is it fair? Is it rational? Yeah. You have to have some more rate of return because you are going to risky investment. එතකොට එතනදී ඔයාලා risk premium එකක් add කරගන්න. ඒතර risk premium එක අපිට determine කරන්න පුළුවන් based on the captain. There are certain other methods in the risk and return එක අපි captain එක apply කරනවා. එතකොට ඒ විදිහට අපි risk premium එකක් add කරගෙන approximately you can decide your required rate of return if you are going to invest in the stock market at least 18%. 18ක්වත් තියෙන්න ඕන. fixed deposit එකක් ගන්නකොට 10ක් හම්බ වෙනවා නම් 11ක් හම්බ වෙනවා නම් if you are investing in the stock market, your expected rate of return around 15%. But risk is at minimum. So likewise, you can take your personal financial management decision. right? Right. So this is you can apply for any asset. Now look at this one. Company is considering, now this is not the financial asset valuation. Company is considering the purchase of a new machine to increase the productivity. The net cash inflow, after considering cash inflow, outflow both, net cash inflow එක මේ machine එකේ හින්දා company එකට හම්බ වෙන net cash inflow from the machine is expected to be 25,000 per year. The lifetime of the machine is 4 years. අපි හිතමු cash flow එක ඇති වෙන්නේ annual. Determine the intrinsic value. If appropriate, applicable, required rate of return, cost of capital, cost of funds, if it is 12%, what is the intrinsic value of this machine? What is the intrinsic value of this machine? Then time value of money කරලා තියෙන්නේ. දැන් මේක වලට හදා ගන්න පුළුවන්. Calculate the intrinsic value. Do it. How much the intrinsic value? Now this is you have learned in the time value of money. How much the intrinsic value? If you look at the picture, if you look at this part, if you purchase this machine for this company, net cash inflow annually 25,000. The lifetime of the machine is 4 years. If you purchase this machine, it will be there for 4 years in the company. Annual net cash inflow, cost of maintenance, ඒ වගේ දේවල් තියෙනවා. ඒවත් consider කරලා ඒකෙන් හම්බෙන return එකත් අරගෙන analyze කරපුවාම net cash inflow එකක් තියෙනවා because of this machine 25,000. 25,000. There is a 25,000 net cash inflow. If company cost of capital or the appropriate discount rate. Company cost of capital mean again it is the investor's minimum required rate of return. With the cost of capital lesson you will learn. If it is 12%, so what is the intrinsic value of this machine? What is the intrinsic value of this machine? What you have to apply? Then आप इधर करते हैं मुकाबले में तो apply करें. Present value of annuity. This is annuity. This is annuity. So apply the present value of annuity formula and calculate intrinsic value. 1 minus 1.12 into the power minus 4 divided by R. So you will get 75,933. Make a 4 years lifetime. That annually it will generate 25,000 inflow. Right. In the marketplace, if you can purchase this machine for 80,000, in the marketplace you can buy. You can purchase this machine for 80,000. Did you buy? In the marketplace, you can buy it for the 80,000. This is your intrinsic value. This is the theoretically, fundamentally value should be for this particular machine according to the theory. What is your decision? What asudharan machine in market take ganna pula. Did you buy? Ganna buy or not? Buy. Ganna. Buy. Because its intrinsic value is less than this. Yeah, may machine එක මට වටින්නේ 75000යි. ඉතින් මම මේක 80000කට ගන්නෙ නෑ. In the marketplace, this is an overvaluation. Marketplace, this machine is selling at lower price, overvalue. So therefore, you are not purchasing. If you can buy this machine for 70,000 in the marketplace, you will buy because you work. The machine is worth for you 75,000. Machine එක 75000ක් වටිනවා. ආවට 70000ක් ගන්න පුළුවන්. So then you will buy. So then normally in the stock market investment also, when the stocks are undervalued, when the stocks are underpricing, you may invest. When the stocks are overpriced, you may not invest. Normally, when there is underpricing, undervaluation in the marketplace, investors are demanding, investors are investing in these shares. So with the demand pressure, price is going up, then market is correcting. So we will come in that point again also. But here, if the price is 70, the price is 70,000. Is the machine overpriced, underpriced, or fair price? In the marketplace, machine is trading for 70,000. In the marketplace, is it overpriced, underpriced, or fair price? Underpriced. Apabila 75,000 are intrinsic value, the market is underpriced, so then you can buy. Buying is a rational decision. Fair price means if you can purchase the machine for the same intrinsic value, so that means fair price. Then අපි stock market invest කරන්න යනකොට දැන් මේක අපි stock market එකට අදාළ security valuation එකකට කතා කරනවා. In the market price and the intrinsic value is equal. If market price and the intrinsic value is equal, we call fair price. Market is fair price. ඒ කියන්නේ market එක well efficient. All the information is incorporated in the market price. So therefore, intrinsic value and the market price both are same. It is an efficient market. Market එක efficient, කාර්යක්ෂමයි. සියලුම information market එකේ shares වල incorporate වෙනවා. එහෙනම් අපේ intrinsic value එකයි market එකේ trading price එකයි දෙකම සමානයි. Underprice වෙලා කියලා කියන්නේ market is not efficient. Some informations are not incorporated in the marketplace. අපි ගාව තිබුණු මොන හරි තව තොරතුරු ඒ market එකේ incorporate වෙලා නැහැ. ඒකනේ ඒක තව underprice වෙලා තියෙන්නේ. In the marketplace, the stock is underpriced. So that means some informations are there to be incorporated in the share price, trading price. Either ඒවගේ වෙලාවට අපි මොකද කරන්නේ? As an investor, you can buy. You may buy. either buy කරනකොට අපි හිතමු මේ මාකට් එක. either අපි ඔක්කොම දකිනවා මේක underpriced වෙලා තියෙනවා. අපි ඔක්කොම මොකද කරන්නේ? මේක demand කරනවා. මේක ගන්නවා. මේක invest කරනවා. either invest කරනවා කියන්නේ demand එක ඉහළ යනවා. when the demand is increasing, price is goes up. either price එක උඩට ඇවිල්ලා market එක correct වෙනවා. Right? So then remember when the underpricing you may invest. අපි හිතමු overprice වෙලා තියෙනවා කියලා. overprice වෙලා තියෙනවා කියන්නේ market එකේ anomaly එකක් overpricing. ඒ වගේ වෙලාවට ඔයාගාව shares තියෙනවා නම් you can sell. You can sell. You are not investing. If you have that shares with you, you can sell. Right? Did you clear this intrinsic value concept? So now in the future we are going to apply this thing for this bond valuation and the security valuation. Another question, another example I will give you. Just write down this. This is also related to asset valuation, right? This is not there in your slide. Suppose there is a special equipment. Suppose there is a special equipment. If you install this equipment, just write down this point, right? There is a special equipment. If you install this equipment, your monthly electricity bill, you can decrease by 10%. There is a special equipment. If you install this machine or this equipment, your monthly electricity bill you can reduce by 10%. Lifetime of this machine equipment is 5 years. Lifetime of this equipment is 5 years, and on average your monthly electricity bill, suppose 10,000. It is changing, but you take it as average 10,000. Your monthly electricity bill assume as 10,000. If your cost of fund or your opportunity cost of fund or your required rate of return, if it is 10%, say not 10%, 12% per annum. If it is 12% per annum, how much would you like to pay for this equipment? Right? There is a special equipment in the marketplace. If you install this, your monthly electricity bill you can decrease, you can reduce by 10%. Lifetime of this machine equipment is 5 years. Average, on average, monthly bill, electricity bill 10,000. Your required rate of return or the cost of capital, your funds, opportunity cost of fund, 12% per annum. To purchase this machine, how much would you like to pay? If you are going to purchase it, how much would you like to pay? So this is the asset valuation. how much would you like to pay? Assuming that you are happy. Yeah. If you purchase this machine or equipment today, lifetime of this equipment is 5 years, so it will be there for 60 months. Right? On average, your electricity bill is 10,000. If you install this special equipment, your electricity bill you can reduce by 10%. How much your monthly cash saving? 1,000. How much your monthly savings or the ඉතුරු ගාන මාසේ 1000 ගාන you can reduce. So then your net cash inflow monthly for 60 months is 1,000. So then what is the intrinsic value? How much would you like to pay for this machine? Is the present value of this net cash savings. So then apply the present value of annuity formula. Monthly saving is 1,000. 1 minus 1.01 into the power minus 60 divided by 0.01. How much? 44,955. 44,955. So that is the maximum you would like to pay. මීට වඩා වැඩි මේක අර දීලා අරගෙන වැඩක් නැහැ. මේක තමයි ඔයාගේ intrinsic value. 44,955. Right? Right. Now we are moving to the bond valuation. So now we are going to apply intrinsic value for the financial assets. So these are fixed asset, real asset. So now we are going to apply this for the financial asset. So what is bond? Bonds, debentures. So likewise we are using different terminologies but with the same meaning. Difference is there. Normally, bonds is a UK version, debenture is, I think this difference is there. If you need, I think it is there. Yeah, bond, yes, it is a UK version, and so likewise, the main difference is when a company is issuing bonds, company keeps some collateral. When the issuing bonds, if they keep some asset as a collateral, so then we call it as a bond. If it is issued without any collateral, so that is we call debentures. Debentures is a form unsecured debt. No any collateral. You can किसी में वास्तव कैपेट किया नेटवर्क bond issue में करना थी ना फिर तो use करना debenture term में. If there is a collateral unsecured as a security, so that is we call bonds. So kind of a difference is there. Bond is the American usage. Debenture is a UK version, UK usage. So likewise difference is there, but anyway no need to have it seriously. Bonds, debentures, both we are using with the same meaning. So what is bond? Bond is a source of debt capital. When it's come to the capital structure of a company, it consists with debt capital and equity capital. So what are the sources of debt capital? Company can raise debt capital by using bank loan and by issuing bonds, debentures, so like. So bond is a source of debt capital. So source of equity capital is the ordinary shares. So when it comes to the debt capital, there is special feature of the debt capital. From investors' perspective, this debt capital are source of fixed income instrument. Is a fixed income instrument. From the company perspective, this debt instrument is a fixed cost instrument. Now, suppose that if you take a bank loan, company has to pay interest. Bank loan company so that interest is fixed. Common shares or dividends for a certain period it is fixed. So therefore, debt instruments special feature of the debt instrument from the company perspective, it is a fixed cost source of instrument. From the investor perspective, is a fixed income investment, fixed income security. Is a fixed income. So likewise, that is a special character of the debt instrument is a fixed cost or fixed income security. So now we are going to discuss the bonds. So bonds is a part of debt capital, debt security that represents loan made by an investor to a borrower, to a company. So bonds can issue by the PLC companies, or private companies also can issue within the shareholders, but PLC company can issue bonds to the general public. So no way to proprietors, partnership can't issue the bonds, only companies, corporations can issue. Bonds are crucial component in the financial market serving means for entities to raise capital, raise debt capital. So what is this bond? So now we are going to calculate the bond value. So when like this, take an example, normal default type bonds. Have you seen bond issue advertisements? Have you seen? Because normally it is published in the papers. When a company is doing a bond issue, debenture issue, they are publishing it in the papers for the general public. Now this is a very recently happened debenture issue, EXC Act. I think it is around January. Yeah, January 1st. So this is a advertisement. Normally you will see in the papers, in the websites. So this is the bond issue announcement, debenture issue announcement. Now you can see how much field opening there and DFCC recognized. Are they working in the DFCC? No. bonds on 5th January 24. Then I will relate. Right. So normally when the company is issuing bonds, suppose this is a company, right? So if they are going to issue bonds, so they have to determine the face value of the bond. Face value of the bond, we call nominal value, face value. In the default, face value we take as 1000. But in this example, you can see they have taken face value 100. It can be, but in our examples, always we are taking 1000. So face value is 1000. And also this company should determine coupon rate. Coupon rate is the interest that bond investor receiving, interest amount. Say like 10%. So they have to determine that. If a company is issuing bonds today, අපි දුන්නා මේ company එක අද තමයි bond එක issue කරන්නේ. So they should determine what is their coupon rate. Annually or semi-annually, quarterly coupon can pay. Then make a coupon is interest payment frequency annual. This is annual coupon. Interest එක තමයි coupon කියන්නේ interest. This is annual. Interest rate is make a 10 එක ගත්තොත් මේකේ bonds දෙකක් තියෙනවා. One is 5 years, other one is 7 years. Look at the interest rate 15.25. But you feel this is reasonable? හොඳයි දැන් අපි fixed rate එක අපිට හම් වෙන්නේ fixed rate 11යි 11යි මේක හැබැයි 5 years. ඒක තමයි අපිට තියෙන risk එක. එතන මේ 5 years තුන market interest rate fluctuate වෙනවා. ඉතින් අපි හිතනවා නම් ඉස්සරහට interest rates බහගෙන යන්නේ කියලා. This is a very good investment. This is a very good investment. For the 7 years, 14.75. Right. So they should determine this coupon rate. Right. Coupon rate by looking at the market and the expected future happenings, economic situation, forecasting the interest rate. So they should determine what is the coupon rate. They are given. No, come.
XP have cricket tournament. So that captain and another will come there. No. They have to go to a meeting there. So we allow to captain. Cricket team. Who is the captain? You.
Two captains. Right. The next Sunday. Right. So then the company should determine the coupon rate by looking at the environment, interest rate behavior, future happenings, economic condition, government analysis. So they have to think about that. So they should determine that. And also the tenor or the time to maturity. Time to maturity. Say for the understanding, time to maturity. May bond එක mature වෙන්නේ කොච්චර කාලෙකින්ද? Time to maturity. Say 5 years. This is a long term, right? Normally, maturity period for the bonds is greater than 1 year. Long term, you are long term investment. So they say 5 years. Face value, coupon rate, time to maturity. So they have to determine. Either මේකත් ඉන්නවා investors. There are investors in the other side. Then they investor, invest so they are looking at this 10% for 5 years. So then this person, investor, is analyzing or valuing this bond to see whether this is a rational, feasible, good investment or not. So bond valuation we can do from the company perspective as well as from the investor perspective. In this discussion, we value the bond from the investor perspective. Only the investor perspective. May aspect එක අපි කතා කරන්නේ. Right? We calculate the based on the investor perspective. Either that may investor, if you invest this bond, now this actually may සම්පූර්ණ මේ කරන්න යන පාඩම I am summarizing, right? If the investor is going to invest in this bond, Now he should calculate intrinsic value of the bond. He should calculate the intrinsic value of the bond. So intrinsic value of the bond, so you know what is the intrinsic value. Intrinsic value is simply future value of the expected cash flow. Future value of the expected cash flow. If the investor is investing this bond today, he can keep this bond until the 5 years. So at the end of each year, he is getting interest 100 rupees. How I calculate 100? Face value is 1000, coupon rate is 10%. Normally coupon we calculate based on the face value. 1000 into 100. So at the end of each year, this investor is receiving 100 rupees from the company for 5 years. Company will default to Lanka. At the maturity, company is paying face value. 1000 and 100 also later. So these are the expected cash flows if you invested in the bonds. Then where bond they are the investor or may company ke bond these are your expected cash flow. Annually you are getting coupon, maybe annually, semi-annually or quarterly, right? You are getting coupon. At the maturity, you will get the face value. Abhi face value redemption price. Face value or redemption price, because the difference between the face value and redemption price. Here we are talking about very conventional type bonds. So normally when a company is issuing bonds, company can say at the maturity, in addition to this face value, you will get 2% premium. Company premium. So then that is redemption price. Face value plus there is another premium. Now the bonds always maturity payment redemption is equal to the face value. So these are the expected cash flow. Then in order to decide whether he is investing or not in this company bond, so what this investor has to do, should calculate intrinsic value. He should calculate intrinsic value. To calculate the intrinsic value, this investor has his required rate of return. Yada tiyanawa yaga required rate of return. Either a required rate of return lekai me coupon rate lekai samana ina me price එක තමයි bond එක trade වෙන්නේ. හැබැයි a required rate of return එකට වඩා me coupon rate එක අඩුයි නම් bond එක under price වෙනවා. Required rate of return එකට වඩා coupon rate එක වැඩි නම් bond එක over price වෙනවා. ඒතර ඔය stories අපි ඉස්සරහට කතා කරමු. Eதாவது he should calculate intrinsic value and then he can compare this and this to take the decision. So these are the nature of the bonds. Eதாவது මේ අතර කාලය තුළ මේ investment risk එකක් තියෙනවා. We call it as a interest rate risk. අයි මේ කාලය තුළ market interest rate වෙනස් වෙනවා. මෙයාට ආවෙන්නේ 10%යි. හැබැයි market එකේ interest rate වැඩි වෙන්න පුළුවන්, අඩු වෙන්න පුළුවන්. So there is a interest rate risk. So you can calculate that. Right. Now if you look at this advertisement, these all the features are there. Look at here. This company is issuing how many debentures? 80 million debentures. Two types, 2 types, 5 years and 7. So you can see interest rate. Interest rate frequency annual hinda. Look at here. What is this A for? Sorry, AER. Yes, annual effective rate. So here you can see effective rate and annual rate both are same. Right? Compound interest frequency coupon frequency annual. This effective rate and both effective rate and coupon rate both are same. Time value or effective rate. So let's see what features here. So these are the bonds. Now let's go to the bond valuation. Make them overall kata throughout this topic. Right. So then what is bond? This is the bond. You can value bond from these two perspectives. Abhi kata karan investor perspective. So these are the features of bond. Par value. the amount that issuer agrees to repay the bondholder on the maturity date. So normally we'll assume it as 1,000. Par value, face value, nominal value, all the terms are used. Par value, face value. So normally at default we take 1,000. Then coupon rate. Coupon rate is the rate that the issuer agrees to pay each year until the maturity. So here 10%. Until the maturity of the bond, 10% coupon agree given. So that is the coupon rate. Coupon. So if you know the par value, face value, and the coupon rate, so then you can calculate coupon. 100 rupees. Face value into coupon rate. 100 rupees. Maturity date. The date when the issuer is obligated to redeem the bond by paying outstanding principal amount. Because the outstanding amount face value, so that is the maturity date. 5 years. In 5 years, this bond will be redeemed. These are basic characteristics of bonds. In addition, if you look at the practice, some additional features can be there. Redemption එක වෙනස් වෙන්න පුළුවන් අතරමැද redeem කරනවා නම් value කරන්න පුළුවන් so likewise practical concerns are there but anyway fundamentally these are the things that we are going to calculate determine the fundamental or the conventional type bond but in practice some difficulties complexities are there. Issue date, the date the bond is issued. Redemption price. Face value and the redemption price can be different. At the maturity, sometimes companies can say they are giving some premium. So then that is the redemption price. It will make us that intrinsic value time to maturity. 5 years. Now say in this example, now you have invested this bond today. After 3 years, right? After 3 years. You are going to the secondary market. You are selling this bond to another investor. This is a tradable. At any time you can sell this bond in the secondary market to another investor. Here at the zero, at the issuance you are taking. You have invested at the initial public offering. After 2 years, now we are going to sell this bond to the another investor. Then so what is your time to maturity? 3 years. Then after 2 years, this is the bond's time to maturity is 5 years. After 2 years, I am selling this to the another investor. So their time to maturity of the bond is 3 years. Time remaining until the bond is mature. So that is reducing over the time to maturity. Required rate of return. This is the bond holders or the investors required rate of return. So the definitions you should know when you are calculating the bond value. Right. So what is the bond price or the bond value? So you can calculate based on this formula. This annual coupon, annually or semi-annually, you are getting coupon. What is that cash flow? This annual coupon is what? That time value of different cash flows value. So this annual coupon, quarterly or semi-annual coupon is what type of cash flow? Annuity. It is annuity. Redemption price. You are receiving in one single period at the maturity. So this redemption price is a single cash flow. Coupon is annuity. So when you calculate the bond value or the price of the bond, this coupon you have to consider as the annuity, calculate the present value of this annuity. Redemption price for the maturity payment, you have to consider as a single cash flow and calculate its value. So this is the formula for the bond pricing. Present value of the coupon, interest, or present value of the maturity value. So these two you have to consider when you calculate the bond value. If I ask a question, now you can say I have mentioned here bond pricing. The mamatwa may have bond value karande. What is the difference between the value and the pricing, or the intrinsic value and the price? What is the difference? Price, normally market trading price. Value is the based on the fundamentals, that is based on the expected cash flows, that is intrinsic value, fundamental value. Price and the value is equal if market is efficient. If it is a bond, if bond market is efficient, perfectly efficient, price and the value both are same. If market is not efficient, price and value can be different. Price එක වැඩි වෙන්න පුළුවන්, value එක අඩු වෙන්න පුළුවන්, value එක වැඩි වෙන්න පුළුවන්, price එක අඩු වෙන්න පුළුවන්. So that is the difference. ඒතර මේ terms දෙක you can see it is used in interchangeably, but anyway the difference is there. Pricing mean trading price. bond එක market එකේ විකිණෙන්නේ කියන. Value mean that is intrinsically you calculated value. This is also not new for you. Now, if the coupon is paid semi-annually, අපි දැන් time value වල මේ වගේ cash flows කතා කරා. If the coupon is paid semi-annually, so what you have to do, you can see. Anyway, with the calculation we can discuss. So then these are the types of bonds. So we are going to value the bonds. Different types of bonds are there. I have listed here only three. Pure discount bond, or we call zero coupon bond, coupon bonds, and perpetual. Different types of bonds can be there. I discussed only the three. Pure discount bond, coupon bond. Coupon bonds is the normal one, and perpetual. So what is this pure discount bond? In case of the pure discount bond or the zero coupon bonds, there is no coupon. There is promised single cash payment at fixed future date. At the maturity, you are getting only the face value. No coupon during the life or during the time of the bond. Coupon net, zero coupon. Zero coupon. If it is a 5-year zero coupon bond, so you have to calculate the intrinsic value of the zero coupon bond, simply maturity payment or the face value discounted back to the 5 years. Because no coupon, annuity can have coupon එකක් එන්නේ නැහැ. Single cash flow එකක් විතර තියෙන. This promise a single cash payment at fixed future date at the maturity date. If the cash flow occurs 1 year from today, we call it as a 1-year pure discount bond. If this maturity payment occurs 5 years from today, we call it as a 5-year pure discount bond. This is a zero coupon bond. So simply you can see the formula. Intrinsic value is equal face value discounted for time or the time to maturity. Then our single cash flow is a present value. The application of that time value of money is single cash flow present value. So you can see the here F is the face value or the redemption value of the bond. Now you know this R is the required rate of return of the investor. N is number of years to maturity. See here example. DND PLC has issued 1-year pure discount bond with a face value of 1,000. If investors require rate of return 15% per annum, how much will he pay to purchase 1-year pure discount bond? This is a type of bond. So then there is a pure discount bond issued by the DND PLC. 1 year. 1 year pure discount bond. So no coupon. Coupon net. So at the maturity you are getting 1,000. This is 1 year. So then simply intrinsic value is equal this. So then how much will the investor pay? If investing on this 1 year pure discount bond, එයාගේ required rate of return එක දීලා තියෙනවා 15%. එතකොට he will pay maximum 869.57. If the current market price is 800, when the price එකයි value එකයි, this is the intrinsic value based on the expected cash flow, right? So then current market price, then if you are going to the marketplace, you can buy at 800. Determine whether bond is underpriced, overpriced, or fairly priced. Is it a fair pricing? No. Maybe intrinsic value. So then here in the marketplace, what has happened? Underpricing. It is underpricing. So then are you investing? This is the intrinsic value. Trading price is 800. So in the marketplace, it has underpriced. Our milakata market take විකිරෙන්නේ මේකට වඩා අඩුයි underpricing. So then what is your decision? Will you invest? Yes or no? ඒක තමයි දැන් decision. Yes. Yes. ඇයි ඔයාට මේක මෙච්චරකට උනත් ඔයා ගන්න කැමති? මේක තමයි ඔයා maximum amount you will pay for if you are going to invest. But in the marketplace, it is underpricing. අටසීයකට පුළුවන්. So then you are investing. එතන මොකද වෙන්නේ? ඔයාලා ඔක්කොම මේක invest කරනවා. So all the investors in the market, when they are looking, this is an underpricing company, bond is underpriced. So then all the investors are demanding, they all are trying to invest. So then with the demand pressure, demand is increasing, market is pressuring with the demand, price is going up. So then it is reaching to this level. So then we call in a short period, market is corrected. එතකොට anomalies තියෙන්න පුළුවන් market එකේ underprice overprice වෙන්න පුළුවන් time to time. හැබැයි ඒක correct වෙන්න ඕන. ඒක තමයි අපි කියන්නේ සාමාන්‍යයෙන් අපි efficient market theory එකට අනුව කියන්නේ anomalies තියෙනවා. අපි යම් කිසි වෙලාවක බලපුවම company එක shares under value වෙලා තියෙනවා. හැබැයි ඒක market එකෙන් automatically correct වෙනවා. demand එක ඇවිල්ලා ඊට පස්සේ මේ price එකට ආවට පස්සේ ආයෙ ගන්නෙ නැහැ. Your investors are not investing. So then market is correcting. So මේකට වැඩියෙන් ගියොත් you may not invest. ඒතර එතනදී invest කරන්නේ නැහැ. හැබැයි වට මේ company එකේ bonds තියෙනවා නම් ඔයා ගාව you better to sell. You better to sell them because overpricing the market එක overpriced වෙලා තියෙන්නේ. So then you better to sell if you are already invested. So next type of bonds is coupon bonds. මේක තමයි default එක. Right? This is the default. Coupon bond. මේක තමයි මම ඔයාලට example එකේදී ගත්තේ. There are some bonds that pay coupon payments at the end of each year. There are some bonds that pay coupon payments at the end of 6 months. So coupon එක annual coupon එක you can have within 6 months as well as at the end of year. Semi-annual coupon වෙන්නත් පුළුවන්, annual coupon වෙන්නත් පුළුවන්, monthly coupon වෙන්නත් පුළුවන්, quarterly වෙන්නත් පුළුවන්. So that is the frequency of the coupon. Right. So there are two types of cash flow. Coupon bonds, there are two types of cash flow. One is coupon payment, other one is redemption or the maturity payment. Coupon payments are occurring at a specified fixed time period. So then we consider it as an annuity. We consider it as annuity, but the redemption price occurred at the maturity. So that is a single lump sum payment. The coupon bond these two cash flows you can expect. Coupon is annuity, redemption price is a single lump sum payment. So then you can calculate the value based on this formula. This is very familiar to you. Coupon we consider as annuity. We calculate the present value of it. face value or the redemption price is considered as a single lump sum payment, discount it and calculate the value. Right. So then value of the bond is equal coupon payment into, this is present value of annuity factor, 1 minus 1 plus r into the power minus 10 divided by r. So see redemption payment or the maturity payment, you are getting face value, it is a single cash into the power. If coupon is paid semi-annually, then if the coupon is paid annually, if coupon is paid annually, if coupon is paid semi-annually, again out of the coupon keep you will get that twice. So then if coupon is paid semi-annually, if this formula you have to adjust. What you have to do? Coupon payment you have to divide by M, R you have to divide by M, N you have to multiply by M, R you have to divide by M, N you have to multiply by M. What is that? M after time value. What is that? What is that? If it is a semi-annual coupon, M is equal to M is compounding frequency per year. So then if it is a semi-annual, so coupon you have to divide by 2, R here you have to divide by 2, N you have to multiply by 2. अभी time value में more frequent compounding पता करें. So when there is a more frequent compounding per year, so you have to adjust the formula like this. M is compounding frequency or the coupon frequency per year. Coupon frequency per year. Now look at this example. ABC PLC has issued 5-year annual coupon bonds. Annual coupon bonds. Coupon is paid annually, which pay 10% per annum with a face value of 1000. Now you can look at the features there. This is the 5-year, make time to maturity, 5-year. This is the coupon bond. Coupon rate is 10%. Face value is given 1000. Deal and face value is 1000 kg. If the required rate of return for an investor is 8% per annum, then method rates there are two rates. One is the coupon rate, other one is investors required rate of return. If investors required rate of return is 8% per annum, how much will he pay to purchase a bond of the ABC PLC, not the DNB? Then DNB company के 5-year annual coupon bond का किए ना, याला 10% coupon का के face value is 1000. Investors required rate of return is 8% per annum. How much the investor will pay if he is going to invest in this bond? मार्क क्वेश्चन का क्या हुआ? मैं बॉन्ड के मार्केट के अट्रैक्टिव है नहीं? In the marketplace, is this bond is attractive one or not? Huh? Investors required rate of return is 8%. The bond coupon rate is 10%. Investors required rate of return means with the prevailing market interest rate. Investor required rate of return is the market going interest rate. It is the current prevailing interest rate. So is this bond is attractive one or not? Attractive है? It is attractive because investor अभी market टेकने की हो, they are invest करना पड़ेगा, fixed deposit टेका करेगा, another alternative investment टेका करेगा, आटा कटा, CN आटा कटा. This is the prevailing market rate, going rate. But in this bond, company is paying 10%. එයාලා ඒක ෆික්ස් වෙලානේ තියෙන්නේ. ඒක වෙනස් කරන්න බෑ. මාකට් ඉන්ටරෙස්ට් රේට් අඩු වුණා කියලා මේක අඩු කරන්න බෑ. මාකට් ඉන්ටරෙස්ට් රේට් වැඩි වුණා කියලා මේක වැඩි වෙන්නේ නැහැ. This is a fix. එතකොට this bond you can see is a attractive one. Make attractive. Investors not make attractive. A income you can see if you calculate the intrinsic value of this bond, it's worth more than 1,000. अब ඉස්සරහට මේ relationship කතා කරලා දැන් මේක intrinsic value එක ඔයාලා calculate කරනවානේ. So you can see the answer, it is greater than the face value. Greater than the face value because of this attractiveness. ඒ කියන්නේ investors ලා 1000ට වැඩියෙන් මේක ගන්න කැමතියි. ඇයි? මේ high coupon එකක. high coupon එකක. capital loss එකක් තියෙන්නේ. මොකද maturity එකේදී හම්බෙන්නේ 1000යිනේ. අද ඔයා 1500ට ගත්තොත් maturity එකේදී හම්බෙන්නේ 1000යි. ඒතර capital loss එකක්. හැබැයි 1000ට වැඩියෙන් උනත් ගන්නවා because of the high coupon. current yield. Okay, අපි ඉස්සරහට තව කතා කරමු. Now you calculate the bond value here. How much the value? So value of the bond is equal. This is annual coupon. How much the coupon? Coupon is how much? 1000 into 8% or 10%. දැන් මෙතන rates දෙකක් තියෙනවා මතක ගන්න එපා. 8% is investors required rate of return. අපි මේ bond එක value කරන්නේ investor එක පැත්තේ. ඒතකොට එයාගේ required rate of return එක තමයි මේ දීලා තියෙන්නේ. company එකේ දෙන coupon එක කීයද? 10%. එහෙනම් coupon is how much? 1000 into 10%, 100. Coupon is 100. So this is the annuity. So 1 minus on the investor required rate of return again the discount කරන්නේ. 1.08 into the power minus 5 divided by R. At the maturity you are getting 1000. Only the face value. So this is 1000 discounted for 1.08 5 years. How much the value? Here we want to consider how much will the investor pay to purchase the bond. What is the intrinsic value? 1000. Thousand 79. So 1079. This is the value or the amount that investor will pay if he is going to invest. Premium එකක් දෙවනවා. Premium අපි කියනවා this bond is selling that premium. අපි ඉස්සරහට කතා කරමු. This is calculating the bond value. 1079 එනවා. 1079.85 correct. How do you find the present value of the bond if the coupon are paid semi-annually? Then අපි කියමු මේ coupon එක 10% coupon is paid semi-annually. 5% at the end of first 6 months, another 5% at the end of next 6 months. So this 10% coupon is paid semi-annually, compounding semi-annually. So then what is the value of the bond? What you have to do? මොකද වෙනස් වෙන්නේ? මේක මෙතනම දෙකේ. You have to divide the coupon by 2. R you have to divide by 2. 5 you have to multiply by 2. R you have to divide by 2. So the R 4% වෙනවා. time එක 10 years 10 මේ NB10 quarter semi annual double වෙනවා. compounding frequency का double वेव. So you will get 1081. For the same bond, if coupon is paid semi-annually, you wish to pay 1081 rather than the annual one. If it is coupon is paid semi-annually, your intrinsic value or the amount you wish to pay for this bond is 1079. If company is paying coupon semi-annually, you prefer to pay, you wish to pay more than that. 1079 only 1081. What is the reason? What is the reason? Same bond, become a bond taker. Features also same. Time also same. The only difference, coupon is paying now semi-annually. Coupon is paying semi-annually, you are paying more than annual coupon bond. What is the reason? Annual coupon लेकर वाड़ा semi-annual coupon लेकर value एक value में and mathematically because of the multiplication of the two and the adjustment. But theoretically, what is the reason? Yes. Compounding impact करेगा mathematically. Because of that, we price का value. What is the theory behind this? आप लोगों को पता है what is the theory? මේකේ මොකද වෙන්නේ? මේකේ රුපියල් 500ක් පළවෙනි මාස 6 අවස්ථාවේ හම් වෙනවා. ඊළඟ 500 ඊළඟ මාස 6 අවස්ථාවේ අවුරුද්දක. ඉතින් මොකද්ද මෙතන මේ 1079 මේ අත මේක 1081 වෙන්න තියෙන්නේ. So what is the theory? What is the theory? What is the theory behind this? High value of money. High value of money because in this semi-annual fund, you are getting some money earlier than the annual coupon bond. So because of that, your value is high. High value of money. Money receiving earlier, more valuable than money receiving later. So that is the reason. Because of that impact, you are paying here more. I following also that interest so therefore you are paying more. So therefore the theory is time value of money. Did you get the answer? Right. So the last type of bond right. Another example is there for yourself. What is the value? Yanasati PLC has issued 18-year bonds with the semi-annual coupons at 15% per annum with a face value of 1,000 rupees. If required rate of return for the investors is 18% per annum, what is the value of the bond? What is the value of the bond? So what is the value of the bond? Is equal, coupon rate is 15%, required rate of return is 18%. Now coupon is less than the required rate of return. Is it attractive bond? Coupon is less than the required rate of return. Less attractive. Make attractive है मेरी invest करना नोटा मैं आने market rate भी ना सीधे दहार तक करना पड़ेगा तब तक भी. So you can see the bond is selling at less than 1,000. अभी ये ना bond is selling at discount. then make वाला value का करता हम already पहले आंसर का दहार नोटा आने. So the bond is selling at discount. Right. Coupon is 150. Now semi-annual, so then 75 into 1 minus 1.09 into the power minus 1 minus 1.09. Time period is 18 years. So take a double by 1, 36 minus 36 divided by 09 plus 1000 1.09 into the power 36. How much is the value? Is it 840? So you can see price intrinsic value is less than the 1000 because the coupon is less than the investors required rate of return, so the bond is selling at discount. Bond එක 10ට වඩා අඩු වෙන නම් විදිහට අපි කියනවා bond is selling at discount. So because of that high less coupon than the required rate of return. අපි ඉස්සරහට ඒ relationship apply කරනවා. Right. So the last type of bond, perpetual. Perpetual is there are some bonds that do not have a maturity. Right? There are some bonds, no maturity. As far as companies survive, companies there, they are getting coupon. So that is we call perpetual type bonds. You can remember in the annuities, under the annuities we discussed perpetual annuity. Perpetual annuity. Perpetual annuity का present value लगाते simply cash flow discounted by discount factor. So same application we here apply for the perpetual type bonds. Value is equal coupon divided by investors required rate of return. For the perpetual bonds, no maturity. There is no maturity. Let's go for an indefinite period. So value, intrinsic value, you can calculate coupon divided by required rate of return. Coupon divided by required rate of return. So say here ABC PLC has issued perpetual bonds. ABC PLC has issued perpetual bonds paying annual coupon 16% with a face value of 1000. If required rate of return is 14% per annum, how much will he pay to purchase this bond? If investors require rate of return is 14% per annum, what is the intrinsic value? How much will the investor pay? This is the intrinsic value of the investor. So simply value is equal coupon. Coupon rate is 16%. So then coupon is 160 divided by required rate of return. Discount factor is the required rate of return. So coupon divided by discount factor required rate of return. So intrinsic value is 1142.86. So this is the perpetual type bonds, no maturity, only coupon is there for an indefinite period. Right. I'm stopping this point, right? I'm not going to continue because I want to continue these two, impact of interest rate and the YTM together. Next week I will continue. I don't know whether you are having the online lectures. Like Sunday, if you have a sport festival, so then you lecture. Mahitane mat already online එකක් arrange කරන්න කියලා කිව්වා. I will discuss with Jennifer and will inform you. So market impact of the interest rate, YTM and currently both I have made it continuously. So therefore I'm not going to continue this one. No time to start and stop. So we are coming the next week. I have uploaded consultation reading material. So please read that one. Come with the proper reading. So then we can finish it and we can watch the security value. Also, your assignment details I have uploaded to the LMS. You can put your own. If you have any question, you can ask. Otherwise, you can use many sources are there now. You can access to the internet, whatever the sources. So you can from the assignment, be ready for that also. Right? Any questions, any clarification? Online account, we also need to